The conspiracy theory here on this desk, Michelle, is that tomorrow's report will be very strong. And that's why Jerome Powell was extra hawkish during the news conference. So what are you looking for tomorrow?
Well, I think, the consensus forecast of somewhere close to 200,000 job growth sounds about right. It would show that the economy is still adding jobs well in excess of what you would need to see to keep up with the labor force. It would show that the unemployment rate should remain sticky low, and it would suggest that we're going to still see wage growth, albeit maybe some moderation in the pace of wage growth. The overall story for the labor market, I think, is still very clear that there's still excess demand meeting a lack of supply, and that's creating this tightness in the labor market, even if it's not quite as tight as it was, say, 6 months ago.
How do you think about the unemployment rate and where it needs to go when the Fed says that the terminal rate is going to be higher and it's going to be there for longer?
Well, when you think about the Fed and their dual mandate, price stability, full employment, I think the general view and what Fed Chair Powell tried to communicate yesterday is that they have done more than they've needed to do in terms of full employment. The unemployment rate is arguably too low. It's creating too much inflationary pressure and too much kind of overheating in that economy. So it's natural to start to see that unemployment rate pick up. And that is what's needed in order to feel confidence that they've done enough in terms of increasing interest rates, transmitting that tighter monetary policy into the economy to hold back inflation. So if you look at the Fed's own forecasts from the September meeting, they have the unemployment rate in the mid 4% range. That might be enough, or maybe it does need to be a bit higher, but it's going to be a function of when you see the shifts in the real economy that really generate that moderation in inflation.
Hey, Michelle, it's Tim. Thanks for joining. So outside of labor, which you've just described is why it's sticky for longer, but at some point there's some relief. But I used the term earlier in the show, folly, as it related to the Fed's 2% inflation target. I think we'll never see that again in my lifetime, based upon a number of secular trends that didn't just happen and the end of 4-decade secular trends that have happened. Your view.
Right. Look, I think 2% is still fair. Think about it. Prior to the pandemic, we were all talking about how we'll never get to 2%, that maybe that inflation target is too high, or maybe we should actually aim even higher because it's so hard to actually generate inflation. And then the pandemic happened, and we saw an extraordinary amount of monetary and fiscal policy. And we saw this, pullback of the supply side of the economy because of supply chain issues and because of the dislocations that the pandemic led. And all of a sudden, we have above 8% inflation, and we've had above 8% inflation for the better part of this year. I do think there is a path to get back to a lower inflationary environment. Look at the good side of the economy. We're already seeing some disinflationary pressure there when you look at core goods. And that's a function of inventory starting to build and the fact that there's still these technological advancements that are ultimately disinflationary. So I think it is achievable. It's just hard to appreciate that when we're in an environment where inflation's been really high for too long.
Michelle, thank you. Good to see you. Michelle Meyer, MasterCard. All right, Steve, what do you make of the action today in terms of anticipation of tomorrow's report?
I think that people have to realize that the market's going to get worse, right? Powell is not going to defend the equity market. The market's going to go lower. Rates are going to go higher. I do believe we're going to get a rally into year end based off the midterm elections. And as I said last night, we're really burning daylight for the amount of days between now and when the election cycle happens going into year end.
Let's just say it's 50-50 and rates are going to go up or down. Start with that premise. If rates are going to keep going up, there's no way the market equities are going to be in good shape. And if rates start dropping here meaningfully, something's wrong. Equities go lower. Either way, what's the premise to be bullish?
What if they stay around where they are?
They've been here forever. Already. It's still, there's just no growth. There's no
lower
reason.
Multiple.
Yep.
It's what you pay for earnings, right? And I'm with Carter on this one. If rates are going down in a meaningful way, something bad has happened, and you're going to bonds as a flight to quality because the equity market's getting torched. And if rates are going higher from here, it's not a good scenario because it's not about growth. It's about inflation still out of control. So I'm with Dubs.
All right.
Dubs.
CBW.
Yeah, well, we just call them Dubs sometimes. It happens, Mel.
You just call them Dubs sometimes.